Imagine you've just landed in Toronto. Not the Toronto from the news, the Toronto from the fantasy. The version people describe when they're tired of chaos and they want something that feels sane. You step outside and everything is clean. The sidewalks are orderly. The trains mostly run. Nobody's screaming at strangers. Even the air feels calmer, like the city is politely asking you not to make a scene. You look up and the skyline is a wall of glass. Condos stacked like vertical hard drives. Everywhere you turn, there's another tower going up, another crane, another promise of modern stability. It feels safe, it feels rich, it feels like you've arrived at the adult version of a country. And at first, it's easy to believe it. You walk into a cafe and order something overpriced without even being offended, because the barista is friendly and the room is quiet and nobody looks like they're about to snap. You sit near the window and listen to people talk. You expect small talk about hockey, weekend trips, maybe the weather. But the conversation keeps circling back to the same thing. Not jobs, not businesses, not politics. Housing. Someone at the next table is talking about a condo they bought 2 years ago that is up more than their salary. Another person is explaining how their friend moved 3 hours away and still can't afford a starter home. Someone else laughs like it's a joke, but you can hear the stress hiding under it, the same way people laugh when they don't want to admit they're scared. You hear words that don't sound like a normal country. Bidding war, pre-approval, variable rate, down payment help, rent increase. My landlord sold. I'm moving back in with my parents. And then, casually, like it's weather, someone says, honestly, it's just the market. You keep walking through the city and you start noticing the same thing everywhere. The billboards aren't about new products or new ideas. They're about towers, pre-construction, deposit structures. Invest now. The ads don't look like housing ads, they look like stock promotions. Even the way people talk about the future has a strange shape. It's not, what do you want to build? It's, can you get in? Not, where do you want to live? But can you qualify? Not, what are you working on? But, what did you buy? And that's when the fantasy cracks. Because a normal country talks about opportunity. It talks about industry. It argues about wages. It fights over jobs. It obsesses over growth. This place is obsessing over shelter like it's a lottery ticket. Which is why the first thing you need to understand is this. You're not entering a country anymore. You're entering a real estate market with a flag. And once you see it that way, everything that looked stable starts to look fragile. Canada's housing crisis is usually told like a weather report. Prices went up. Rates changed, supply is tight, demand is strong. It's framed like a natural phenomenon, like nobody is in control and everyone is just reacting. But that story is comforting, because if it's weather, then there's no one to blame and no system to question. You just bring an umbrella and hope it passes. The truth is darker. Canada did not accidentally inflate housing. It engineered a world where housing could become the safest, cleanest, most politically protected engine of growth it had. Not because Canadians are uniquely greedy, or because everyone woke up one day and decided to gamble on condos, but because when an economy runs out of easy productivity gains, when growth slows, when wages stop rising like they used to, governments still need something that feels like progress. And housing is the perfect illusion of progress. A factory is complicated. Innovation is risky. Building a new industry takes years and failure is visible. But when home prices rise, the country looks richer overnight. People feel wealthier. Banks expand lending. Governments collect more revenue. GDP gets a boost. The headlines stay calm. Everyone can pretend the machine still works. So housing quietly became the growth model. And once that happens, mortgages stop being a tool for buying a home. They become the fuel that keeps the national story alive. Debt replaces productivity. Interest replaces innovation. And the country gets addicted to the one thing it can't afford to lose: higher prices. That's the mortgage trap. Here's how it works. First, rising prices force more debt. Not because people want to be reckless, but because they have to. If a home costs more than the last year, you either take on a larger mortgage or you're locked out. So the average buyer becomes more leveraged just to stand still. Second, more debt props up the economy. When mortgage lending expands, it flows through everything. Real estate transactions, construction, renovations, broker fees, legal fees, home insurance, furniture, appliances. Every new mortgage is an economic event. It looks like growth, It is counted as motion. It keeps the numbers alive. And third, once GDP becomes dependent on that debt, prices become untouchable. Because now a price drop isn't just a correction. It's a threat to consumption, to employment, to financial stability, to political survival. The system becomes trapped, defending the very thing that's crushing the next generation. You can see the trap in how people talk. When prices rise, it's called wealth. When prices fall, it's called a crisis. That's not a market. That's a dependency. And here is the darkest irony of the entire Canadian story. A country can look rich while getting poorer. Because if your wealth is mostly a number on a house you already live in, and your economy is powered by borrowing against that number, you're not getting richer. You're just inflating the cost of being alive. And once an economy starts doing that, the trap doesn't end with housing. It spreads into everything. To understand why housing could take over an entire country, you have to look at what quietly disappeared first. Canada didn't wake up one morning and decide to become a housing economy. It drifted there. Slowly, politely, almost invisibly. For decades, economic growth came from things that were hard but productive. Manufacturing, resource extraction tied to value-added processing, building companies that exported goods, not just assets. Productivity went up, wages followed. When people got richer, it was because they were making more, better, or faster than before. Then that engine started to stall. Globalization squeezed manufacturing margins. Automation reduced labor demand. Productivity growth flattened. It became harder to grow the economy by making and exporting things. And when that happens, governments face a problem they never say out loud. Voters still expect rising living standards, but the old tools no longer deliver them. So the economy found a substitute. Housing filled the gap. Real estate has one magical property that factories don't. You don't need to invent anything. You don't need to compete globally. You don't need to increase efficiency. Prices can rise simply because more money is chasing the same land. And when they do, it looks like success without effort. Construction ramps up. Realtors multiply. Mortgage brokers appear everywhere. Banks expand their balance sheets. Home equity gets extracted and spent. Suddenly, entire sectors are busy, employed, and profitable, all without the country producing a single additional unit of exportable value. Over time, this reshapes the economy itself. Construction, real estate services, and banking begin to dominate GDP growth. Not in dramatic headlines, but in quiet percentages that compound year after year. When policymakers look at the numbers, they see activity, they see employment, they see rising asset values, and they call it health. This is where the illusion locks in. Rising home prices are framed as wealth creation. Politicians stand at podiums and talk about strong housing markets the way previous generations talked about strong industries. Homeowners feel richer on paper. Governments collect more through property taxes, land transfer taxes, and sales taxes on everything connected to housing. The feedback loop feels positive, but none of this is productivity. Nothing new is being created, no efficiency is gained, no innovation is scaled. The same houses simply cost more than they did last year, and that increase is treated as if it were economic progress. This is asset inflation masquerading as strength. It's the difference between a company growing because it sells more products and a company growing because its stock price goes up while sales stagnate. One builds capacity, the other builds fragility. And once an economy starts confusing higher prices with higher output, it becomes vulnerable in a very specific way. Growth stops depending on what the country can do, and starts depending on what people are willing, or forced, to borrow. At that point, housing isn't just part of the economy anymore. It is the economy. Now let's zoom in from the national story to the part that actually matters, the household math. Because you can debate macroeconomics forever, but you can't debate a monthly payment. Picture a first-time buyer, not a speculator, not a landlord with 5 doors. Just a normal person doing what people were told to do for generations. Get a stable job, save a down payment, buy a modest home, build a life. They open a listing app and see the numbers. Not luxury, not a mansion, a basic place where you can raise a family and not hear your neighbors breathe through the wall. The price is already higher than what their parents would have considered absurd. So they do what everyone does now. They don't ask, is this worth it? They ask, can I qualify? That question alone tells you something has broken. Because in a healthy market, people decide what to buy based on value. In a trapped market, people decide based on approval. The bank becomes the real buyer. and you become the person renting the purchase from them for decades. Here's the collision. Incomes do not rise at the speed of home prices, not even close. So, to bridge the gap, the system stretches time. Longer amortizations, smaller down payments, higher leverage. The same logic as every addiction. Make the dose cheaper today by making the consequences longer tomorrow. That's how you get 30-year mortgages becoming normal. Not because they're good, because they're necessary. They are the financial equivalent of lowering your standards and calling it maturity. A 30-year mortgage does something subtle to the brain. It turns an emergency into a lifestyle. It normalizes desperation. It tells people, yes, this is expensive, but don't worry, you'll be paying for it until you're old enough to need it less. It doesn't solve affordability. It just spreads the pain thin enough that it becomes politically survivable. And even then, many people can't make the numbers work, so they rent. But renting used to be a phase, a transition, a few years while you saved, a temporary chapter before you stabilized. Now, it's permanent. In many Canadian cities, the rent is not something you endure on the way to ownership. It's the price you pay, because ownership is no longer a realistic option. And the cruel part is that rent doesn't build you anything. It doesn't convert into equity. It doesn't move you closer. It simply consumes your margin, month after month, while prices keep running away. This is where the trap becomes psychological. People aren't just priced out of housing. They're priced out of the future. They can't plan. They can't relax. They can't take risks. They can't start businesses. They can't have kids unless they gamble on stability they don't actually have. Life becomes a sequence of financial decisions made under pressure, and that's why the most honest way to describe it is this. You're not buying a home, you're buying survival with interest. Because the mortgage isn't just a loan anymore. It's the entrance fee to a normal life. If you want to understand why Canada's housing market feels untouchable, stop looking at houses. Look at the banks. Because in Canada, the housing market isn't just a place where people live. It's the core asset on the balance sheets of the most powerful financial institutions in the country, and that changes everything. Canadian banks are not neutral observers. They are mortgage machines. Their stability, their profits, and their entire business model are deeply tied to the idea that Canadian housing is a safe, rising, low-risk asset class. That's not a conspiracy. It's structure. When a country's banking system is heavily exposed to mortgages, you get risk concentration. In plain English, too much of the system depends on one thing continuing to behave nicely, and for years, it did. Prices rose. Defaults stayed relatively low. The narrative became self-reinforcing. Housing is safe, because housing has always been safe. But that safety has a hidden condition. Housing is safe as long as prices keep rising, or at least never fall hard. Because if prices fall sharply, a chain reaction starts. Homeowners who bought near the peak can go underwater. Refinancing becomes harder. Consumer confidence collapses. People spend less. Delinquencies rise. And suddenly the asset that was treated like a rock begins to behave like a leveraged bet. Banks understand this better than anyone. Which is why they don't just lend into the market, they shape its boundaries. Lending standards, mortgage products, amortization lengths, stress tests, refinancing culture. These aren't just consumer conveniences, they are pressure valves designed to keep the machine from seizing. And here's the critical point. When your financial system becomes this dependent on housing, the country's definition of stability changes. Stability no longer means people can afford homes. Stability means prices don't drop. Those are not the same thing. Now add the next layer. Government backstops and guarantees. Canada has structures that make the mortgage system feel even more secure. Insurance, guarantees, institutional support, the kinds of mechanisms that tell investors and banks this is protected. In theory, these policies exist to make housing finance safer for everyone. In practice, they also reduce fear in the system, which makes it easier to expand lending, which supports higher prices, which creates more dependence on higher prices. That's the loop. More mortgage lending inflates prices. Higher prices require larger mortgages. Larger mortgages expand bank exposure. Greater exposure increases the political need to protect stability. Protection encourages more lending, round and round. This is why every time the market wobbles, the conversation immediately becomes about confidence, liquidity, and stability, not about affordability. Because affordability is a social problem. Stability is a financial problem, and financial problems get emergency responses. And that leads to the darkest irony in the Canadian story. The system is called safe, because it cannot be allowed to fail. That's what people mean when they say Canadian housing is stable. They don't mean it's healthy, they mean it's politically protected. They mean there is too much at stake to let it unwind naturally. In other words, the safety is not proof of strength. It's proof of dependency. This is the part where most conversations collapse into shouting, so it's important to slow down and be precise. Population growth increases demand. That is not an opinion, it's arithmetic. When more people arrive in a country, they need places to live immediately. Not in 10 years, not after zoning reform works its way through City Hall. Right now, Canada has grown its population rapidly, and that growth collides head-on with a housing supply that moves slowly by design. Homes take years to plan, approve, and build. Infrastructure lags. Skilled labor is limited. Local opposition is constant. Even in the best-case scenario, supply reacts like a heavy ship trying to turn in shallow water. So demand surges faster than housing can respond. That alone would be manageable in a flexible system. But Canada's housing system isn't flexible anymore. It's politically frozen. Here's where the paralysis sets in. Any policy that seriously lowers prices creates instant enemies. Homeowners who bought recently see their net worth threatened. Older owners see retirement plans wobble. Banks see balance sheets weaken. Municipalities see tax bases shrink. The moment prices fall, the phone lines light up. On the other side, any policy that aggressively raises supply also creates enemies. New development threatens neighborhood character. Density angers local voters. Construction disrupts daily life. Property values might not fall, but they stop rising. And in this system, even stagnation feels like loss. So politicians face a trap with no clean exit. Lower prices and anger millions of homeowners who vote reliably and loudly, raise supply fast enough to matter and anger the same group, just more slowly. Do nothing, and prices keep rising, pushing renters and younger Canadians further out of reach, but those groups have less political leverage, less accumulated wealth, and often less faith that the system will ever work for them anyway. This is why the debate never resolves. Every proposed solution creates a larger, angrier voting bloc than the problem it's trying to fix. The people harmed by inaction are fragmented and future-focused. The people harmed by change are concentrated, organized, and immediate. And because housing is no longer just shelter but a core financial asset, the political incentives are brutally clear. Protect the present at the expense of the future. Manage the optics, delay the reckoning. This is not a failure of compassion. It's a failure of incentives. In a system where housing underpins household wealth, bank stability, and government legitimacy, paralysis isn't a bug. It's the default outcome. Here's how the mortgage trap protects itself. It tells a success story. Not the kind of success you can eat, or build, or export. A paper success. A psychological success. The kind that shows up in headlines and dinner conversations and makes everyone feel like the system is working even as it quietly drains the real economy underneath. The story goes like this. Housing prices are rising, therefore Canadians are getting richer. Your home is worth more. Your equity is up. You have wealth. And if you have wealth, the country must be doing well. Politicians love this story because it's clean and emotionally satisfying. It makes people feel successful without needing to talk about wages, productivity, or competitiveness. It turns an affordability crisis into a prosperity narrative. But that's the trick. Rising home equity is not the same thing as rising prosperity when the cost of living is rising with it. If your house goes up in value, but so do the houses you might want to move into, you didn't gain freedom. You gained a bigger number attached to the same shelter. For many people, that number is not a tool, it's a trap. It can't be used without borrowing against it, downsizing, or leaving the city entirely. And borrowing against it just feeds the system again. This is why wealth in a housing economy often looks like debt in disguise. Now, zoom out to the national level, and it gets worse. When the economy becomes housing-led, GDP growth starts to lean on transactions. Buying and selling homes creates measured economic activity. Real estate commissions, mortgage fees, legal services, appraisal services, renovations, moving costs, new furniture, appliances, property taxes. A single home sale ripples through dozens of industries. So when housing is booming, the economy appears strong, the numbers look good, the government points to growth, but the growth is not coming from higher productivity, it's coming from higher prices and more debt. That's why you can have a country where the skyline is full of cranes, while the underlying productive capacity barely improves. And this is where the phrase, house rich, cash poor, becomes the most honest summary of modern Canada. A household can have a home that's worth a fortune on paper and still feel financially squeezed every month. Mortgage payments, property taxes, insurance, maintenance, childcare, groceries. The cash flow reality becomes tighter even as the asset value rises. People feel trapped in their own wealth. Meanwhile, beneath the surface, productivity stagnates. This is the quiet collapse that doesn't trend on social media. Productivity is the boring metric that decides whether a country can actually get richer without inflating prices. It's the difference between earning more because you produce more value and earning more because your assets got repriced upward. In a healthy economy, productivity growth raises wages and expands opportunity. In a housing economy, asset inflation raises barriers and concentrates wealth among those who already own. And here's the cleanest way to see the illusion. It's like losing weight by selling your furniture. Yes, the number on the scale goes down. Yes, it looks like progress. But you didn't become healthier. You just removed pieces of your life to make the metric look better. You can celebrate it for a while until you realize you're sitting on the floor. That's Canada's housing prosperity story. It makes the country look richer by quietly making normal life harder to afford. At this point, the obvious question is the one everyone avoids saying out loud. What happens if prices fall? Because if housing is the engine, a price drop isn't just a correction, it's a stress test of the entire model. Start at the household level. When someone buys near the peak with a high leverage mortgage, their equity is thin. If prices slide, even modestly, that equity can vanish fast. And once a homeowner owes more than the home is worth, you enter negative equity, the financial purgatory where moving becomes impossible and selling becomes a loss you can't afford to realize. Negative equity isn't just an accounting detail. It changes behavior. People stop spending. They stop renovating. They stop taking risks. They cling to their jobs, even bad ones, because they can't relocate. They become less mobile, less flexible, and more anxious, which is exactly the opposite of what a dynamic economy needs. Now, scale that up. If a meaningful share of households are underwater or feel like they're about to be, consumer spending gets hit. In a country where household consumption is a major driver of the economy, that's a problem. It's not dramatic at first. It's subtle. Fewer restaurant nights, fewer upgrades, fewer purchases that keep small businesses alive. The economy doesn't crash like a movie. It tightens like a noose. Then you hit the banking layer. Banks don't need a housing crash to feel pain. They need uncertainty. When prices fall, lenders become more cautious. Credit tightens. Refinancing becomes harder. People who were relying on rolling their mortgage, extending amortization, or extracting equity suddenly face a wall. Delinquencies don't have to explode immediately. The system can seize simply because credit stops flowing. And remember, in a mortgage-heavy system, housing isn't just a consumer product, it's collateral. It's the foundation under other loans. If the value of collateral becomes questionable, the whole credit machine becomes more conservative. Which brings you to the political reality. When prices are rising, politicians can call it prosperity. When prices are falling, politicians call it a crisis because it is. Not because falling prices are morally bad, but because falling prices threaten voters, banks, employment, and government revenue all at once. And that creates a powerful incentive to intervene. The pressure for emergency measures becomes immediate. Subsidies, relief programs, rule changes, liquidity support, anything that stops the decline from accelerating. That's why housing corrections rarely get a clean, natural reset in systems like this. Because the moment prices begin to fall, the people who benefit from stable or rising prices become loud, organized, and politically urgent. And the institutions that depend on housing stability start treating the market like a patient in intensive care. This is the central tension of the mortgage trap, the one that makes it so hard to escape. Prices must fall for people but cannot fall for the system. Affordability requires relief. Mobility requires lower entry prices. Younger households need a reset. Renters need breathing room. But the financial and political machine is built on the opposite assumption, that prices should remain stable, or at least never fall hard enough to break confidence. So Canada ends up trapped in a state where the solution is also the threat. And when a country reaches that point, the question stops being, will prices fall? The question becomes, how much pain will the system accept to prevent it? If you're watching this from outside Canada, it's tempting to treat it like a local scandal. A weird Toronto problem, a Vancouver problem, a market that got overheated and needs time to cool off. But that's the wrong frame. Canada is not an exception. It's a preview, a time machine. Because the forces that created the mortgage trap are not uniquely Canadian. They're the same pressures squeezing most wealthy Western democracies. Slowing productivity, aging populations, high cost of living, political addiction to stability, and a public that has quietly been trained to treat housing as the safest path to wealth. You can see the same pattern in Australia, a wealthy country with beautiful cities where housing became a national obsession and a political third rail. You can see it in the United Kingdom, where property has become the dividing line between security and permanent fragility, and where entire generations have been pushed into long-term renting while prices stay politically protected. And you can see it across parts of Europe, not always with the same intensity, but with the same logic. Asset inflation filling the gap where productivity should have been. Cities turning into investor playgrounds while locals get pushed outward. Governments caught between the need for affordability and the fear of triggering a financial chain reaction. Canada just got there earlier. That's the important point. Canada wasn't necessarily more reckless. It was simply more exposed to the cycle. A financial system deeply tied to mortgages, a growth model that leaned hard on real estate activity, and cities that became global magnets for capital in a world hungry for safe assets. So when people in other countries say, "That could never happen here," they're usually describing the early stage of the same disease. They're looking at today's prices and thinking it's temporary. Canada shows you what happens when it isn't. It shows you what happens when housing becomes so central to household wealth that no politician can allow it to correct. It shows you what happens when wages don't catch up but debt does. It shows you what happens when stability starts meaning prices can't fall, even if that stability is slowly strangling the future. And it also shows you something else, how decline can feel calm. No riots in the streets, no dramatic collapse. Just a slow loss of mobility, a slow narrowing of options, a slow migration of young talent away from the cities that no longer make sense, and a quiet cultural shift where people stop expecting ownership as a normal life stage. That's why Canada is the perfect warning flare. Not because it's the worst case, but because it's the most believable case. The kind of failure that happens in a country everyone assumes is doing fine. Canada didn't fail differently. It just failed politely. And if your country is following the same path, the polite version of failure is the one you should fear most, because by the time you admit it's happening, the trap is already locked. So where does this go? Because at this stage, the mortgage trap doesn't end with a single policy announcement or a clever new program. It ends the way all structural traps end, with trade-offs that are painful enough that nobody wants to pick them. Canada is staring at two futures, and neither one is comfortable. Future one is the controlled reset. Not a crash, not a headline apocalypse, a slow deflation. A long period where prices stop running, drift downward in real terms, and the economy absorbs the shock the way a body absorbs a fever, weak, tired, but alive. This path means slower growth. It means political pain. It means admitting, out loud, that housing cannot be treated as the national retirement plan. It means accepting that wealth built on endless price inflation was never sustainable in the first place. It also means disappointing a lot of people. Homeowners who bought at the peak would feel trapped, investors would feel burned, construction would slow, governments would lose some revenue. The public would panic the first time prices meaningfully decline because the country has been trained to treat falling home values as an emergency. But this future has one massive benefit. It reopens the door. It gives younger Canadians a chance to enter life without 30 years of financial submission. It allows wages to matter again. It forces the economy to find growth and productivity instead of leverage. It is painful, but it's reality-based. Future 2 is the permanent debt society. This is the path of least resistance, and that's why it's the most likely. In this future, prices don't dramatically collapse. They simply remain high enough that ownership becomes a privilege, not a norm. The system adapts by stretching debt longer, subsidizing demand, and managing the optics. Renting becomes the default lifestyle for a permanent class of people who are essential to the economy, but locked out of its main wealth-building asset. Mobility declines, risk-taking declines, family formation declines. People stop moving where opportunity is and start moving where rent is barely survivable. Entire cities become financial instruments, places you can own, but not necessarily live. The country still looks stable in postcards. The skyline still glows. The cafes are still full, but the future becomes smaller. And the cruel part is that this future doesn't feel like collapse. It feels like normal, just slightly worse every year, a little more debt, a little less hope, a little more distance between the people who own assets and the people who serve them. Neither future is a clean escape. The difference is that one future breaks the illusion now, while the other preserves the illusion and breaks the society later. And that leads to the moral of the story, the line that explains not just Canada, but any country building its stability on rising shelter prices. An economy that survives by inflating shelter will eventually suffocate inside it. Because shelter is not a luxury good, it's the foundation under everything else. When you turn the foundation into a speculative asset, you don't just raise prices, you reshape life, you reshape risk, you reshape who gets to build a future. And if you want to see where else this loop is tightening next, the sequel is already written. In the next video, we're going to look at Australia, a country caught in the same housing-led model and why its version of the mortgage trap might be even harder to escape. I'll see you there.